Welcome to another explainer. Today, we're taking a building block approach to understanding how the massive puzzle of our national economy actually fits together. We hear terms like GDP and national income thrown around all the time, but understanding how they're actually built from the ground up, it's incredibly fascinating. So let's just dive right into the big question. What actually makes a country rich or poor? You might think having abundant natural resources like minerals or massive forests would be an automatic golden ticket to wealth. But history, and current global economics for that matter, show us that some incredibly resource-rich regions have some of the poorest economies. Meanwhile, some highly prosperous countries possess almost zero natural wealth. So, what exactly is the missing ingredient here? Well, Adam Smith hit the nail on the head in his pioneering work. The crucial point here is that a nation's wealth comes from how resources are transformed through a production process to generate income, not just possessing them. A resource only becomes economic wealth when human beings combine their energy with their environment and technology to actively produce something of value. To really grasp this whole macroeconomic picture without getting overwhelmed, we're going to build our knowledge step by step. First, the true wealth of nations. Second, categorizing our economic goods. Third, stocks, flows, and where. Fourth, the circular flow. And finally, calculating our national income.
All right, part one, the true wealth of nations. Let's see how this builds our understanding of economic activity at its most basic level.
Think of modern economic wealth as an active, never-ending flow. It's the continuous production of goods and services by millions of different enterprises. We're talking about everything from a single local entrepreneur baking bread all the way up to giant multinational corporations building airplanes. Wealth is this constant, buzzing flow of production. Moving on to part two, categorizing our economic goods. Since we know production is the main event, we need to figure out exactly what kind of stuff we're actually making. So, the absolutely crucial distinction here is between goods that are completely finished and those that are basically just stepping stones. Final goods have passed completely out of the active economic flow. Think of a finished shirt you buy at the store. Intermediate goods, on the other hand, are things like steel sheets, raw cotton, or yarn. They're produced solely to be used as raw materials or inputs to make other commodities. And here's where it gets kind of fascinating. A goods category depends entirely on how it's used in the economy, not just what it physically is. Let's use the tea leaves test. If you buy tea leaves and brew them in your own kitchen, they're final goods because home cooking isn't a market activity. But if a restaurant buys those exact same tea leaves to brew and sell to paying customers, those leaves become intermediate inputs for adding economic value. Now, even looking just at final goods, we have to split them up. On one hand, you have consumption goods. Your food, your clothing, movie tickets, things literally consumed by the ultimate user. On the other hand, you have capital goods. These are your tools, implements, and machines. They make production feasible, but they don't get transformed themselves. Like a factory's loom is a final good because it's completely built, but it's a capital good because its entire job is to help make other goods for years to come. Okay, part three, stocks, flows, and where. Now that we know our goods, let's explore how time messes with them. Getting a grip on the mechanics of time and macroeconomics is absolutely vital. If you mix up a yearly flow with a static stock measurement, you're looking at a massive accounting headache. Think about it. If I say the output is 10,000 rupees, that's totally meaningless. Is that per day? Per year? That's a flow. It happens over a period of time. A stock, though, is a snapshot at one exact moment, like checking the total number of machines sitting in a warehouse right now. I actually love the water tank analogy for this, because it grounds it so perfectly in reality. Picture a water tank. The water flowing out of the tap and into the tank every minute, that's a flow. But the total volume of water just sitting in the tank at exactly 2 p.m. today, that's a stock. It makes it so easy to picture how a daily flow of newly manufactured capital goods eventually adds up to our nation's total stock of capital. But of course, there's a catch. Our stock of capital doesn't stay shiny and new forever, right? Because capital goods slowly wear out. Say, a factory machine with an expected 20-year lifespan. A significant part of our current economic production just goes toward maintaining what we already have. This expected wear and tear is called depreciation. We absolutely have to account for the fact that our capital is constantly being used up. So if we want to find the true new addition to our nation's capital stock, we simply take the gross total of capital goods produced, our gross investment, and subtract that depreciation, wear and tear. This gives us our net investment. It's the honest measure of how much our productive capacity has actually grown, rather than just looking at what we spent fixing old, broken parts.
Let's zoom out a bit for part 4, the circular flow. We're going to see how all these microelements sum up in a simple economy without a government or external trade. To really get this flow, you just have to follow the money. Specifically, how people get paid. Households provide 4 fundamental contributions to production, known as factors of production. In return, firms pay them specific types of income. If you provide labor, you get a wage. Provide capital, you earn interest. If you provide entrepreneurship, you seek a profit. And if you provide fixed natural resources, like land, you earn rent. And so the entire income of the economy moves in this continuous closed loop. Firms pay households those wages, rents, and profits for their production efforts. And then what happens? Households turn right around and spend that exact same money back at the firms to buy final consumption goods. Production creates income, which creates expenditure, which buys the production. It's literally a closed loop of economic life. Which brings us to the whole shebang, part 5, calculating our national income. Let's translate that circular flow into the actual numbers you hear about on the news. So, how do we actually measure all this buzzing activity? I mean, we can't exactly add tons of wheat to a bunch of cars and yards of cloth. It doesn't work. So, we use money as our universal measuring rod. But, and this is absolutely crucial, we sum the monetary value of only final goods. Think about it. If we counted the farmer's raw cotton, and then counted the textile mill's yarn, and then counted the final shirt, we'd be counting the same underlying cotton 3 times. That error of double counting would wildly exaggerate our true economic wealth. To make absolutely sure we only count things once, economists use this brilliant concept called value added. It's exactly what it sounds like, the net contribution made by a specific firm. It's simply the value of what they produced minus the value of the intermediate goods they used up to make it. This means every single time you buy a coffee, the final price is justified by the exact value added at each step, the farmer, the roaster, the barista, and those additions become their respective incomes. And that brings us to the big one, the most famous economic metric out there, gross domestic product, or GDP. GDP is simply the grand sum total of all those individual value additions across every single firm in the whole nation within a year. It is the ultimate scorecard of our aggregate production flow. Now, just like we talked about with investments earlier, we have to make a choice. Do we want the gross number or the net number? Gross value added includes all that wear and tear on our capital. But net value added takes that final GDP number and deducts the value of the depreciation our machines and buildings have undergone. It's a slightly smaller, but a much more honest accounting of what we actually gained this year. All right, so we've built up the mechanics of measuring national income from the ground up. But this leaves us with a pretty provocative thought. We know exactly how to calculate GDP perfectly now. But does this giant accounting number actually mean we're living better lives? Does maximum production automatically equal maximum human welfare? It's a question every economist has to wrestle with as they look beyond the balance sheet. Keep that in mind as you look at the world around you. Thanks for joining me on this explainer.